Hi everyone. We are now going to discuss first paper of JIB, which is Indian economy. In Indian economy, we are going to discuss now Unit 7 of Module A, which is economic reforms. What are the objectives we are going to discuss in Unit 7 economic reforms? It is economic reforms, economic transformation of real sector, economic transformation of financial sector, economic transformation and integration with the global economy, economic reforms in India. These are the topics we are going to discuss in Unit 7, which is Indian economic reforms. What is economic reform? It is a process where a government specifies a declining role for the state and expanding one for the private sector in the economy. So, in short, what we can say in the economic reform, changes introduced by the government to bring an what the purpose of changes done by government to bring an improvement in the economy of a country through various reforms and policies. The main aim of changing so many policies by government is for expanding there should be an improvement in our economy, so it's the main aim for that. Refers to deregulation or at times shrinking the size of government to remove distortions caused by regulations or the presence of government rather than new or enhanced regulations or government programs to alleviate means to reduce distortions caused by market failure. So if any distortions are occurring in market failure, there may be so many regulations will get. So to overcome all this, the government taking so much of changes for the policies to improve the economy of a country. New economic reforms. It refers to the neoliberal policies put in place by the Indian government in 1991. What are the main three pillars in new economic reform? We have earlier discussed in Unit 1 about LPG, right, which is liberalization, privatization, globalization. Okay, what is the main aim of new economic reforms? To accomplish high economic growth, lowering inflation, minimize the current account deficit, and address the balance of payment issues. And also, policy changes were made in the areas in which areas policy has changed: technology advancement, industrializing, abolition of restrictions on the private sector, foreign investments, and foreign trade. Attracting significant FDIs was one of the key goals of 1991 economic reforms. What is the main purpose? What is the main goal of 1991 economic reforms process? It is nothing but attracting FDIs. Okay. Next, we are discussing that LPG concept, which is liberalization, privatization, globalization. What is liberalization? Liberalization was conceived with the idea that regulations imposed on trade agreements must be relaxed in favor for trade to thrive. Thrive in the sense grown well, flourish. It enabled the opening of economic frontiers for international investors and multinationals. Several economic reforms enforced by liberalization include enhanced production capacity, abolition of government industrializing, and the liberty to import goods. What is the main thing we can understand through liberalization? It is nothing but regulations imposed on trade agreements. Trade agreements must be relaxed. Okay. Here also include enhanced production capacity, means there have to be an improvement in production capacity. Next, coming to privatization. Privatization term means we have known very well about privatization term, which is burning topic now. Privatization refers to providing private sector more opportunities to oversee. Private has more access, private sector more opportunities, various services, while limiting the role of the public sector. Means in privatization there should be a main role of private sector. We can easily say that privatization means there should be a more than 50%, more than 50% share should be of the private sector. Privatization introduced in India as part of reform invited more and more foreign participation and FDI flow, which will provide healthy competition to Indian goods and services. Next, what is globalization? It is nothing refers to the integration of the Indian economy with the global economy. It is now more dependent on the global economy, which Indian economy is more dependent on the global economy, and global economy is also more dependent on the Indian economy. It is both vice versa. It encourages FDIs and international trade with various countries. Due to various globalization policies, India could be able to attract foreign capital and knowledge to boost its domestic capacity. Next, economic transformation financial sector. There were several committees that were aimed to make reforms. Just remember these committees and also their years. First, Chakravarti Committee on Monetary Policy 1985. Narasimhan Committee 1 on Financial Sector Reforms 1991. Padmanabhan Committee to Review Bank Supervision 1996. Narasimhan Committee 2 on the Review of Banking Sector Reforms 1997. Verma Committee on Weak Banks 1998. R.H. Khan Committee on Harmonization of Role of FI Banks 1998. Just remember these 6 committees and also the years. Next we are discussing the first, which is first phase of reforms, the Narasimhan Committee 1992. Okay. The Committee on Financial System. The Committee on Financial System has under the chairmanship of Narasimhan Committee, who appointed it appointed by Government of India. Based on these committees' recommendation, RBI has issued new guidelines on income recognition, asset classification, provisioning reforms. By Narasimhan Committee, he is under the chairman. He has given the chairmanship of Committee on Financing System, and also RBI issued guidelines on income regulation, asset classification, provisioning requirements on Narasimhan Committee, and new standards put the banking sector attention to credit risk recovery and management. What are the main important that took place in 1992 was capital advocacy norms, progressive reduction in CRR and SLR, deregulation of lending rates, credit delivery, DRT, debt recovery tribunal, strong supervisory system, entry of new private banks, mergers and amalgamation. These are the things happen in the first phase of reforms of Narasimhan Committee, which is very, very important. Second phase of reforms. Committee on Banking Sector Reforms was chaired by Narasimhan in order to review the progress of banking sector reforms. What are the benefits of second phase reforms? That is deregulation of bank branch licensing, prudential norms on disclosure requirements, capital advocacy. In this, we are going to discuss prudential reforms, which includes phased implementation of international best practices and rules, which will lower the total risk of the banking system. The main focus of these reforms, prudential reforms, main focus are in 3 areas. Prudential reforms will have main focus on 3 areas, which is NPA, capital advocacy, diversification of operations. These are the 3 areas which prudential reforms have more focus. What is the main aim to directing the resources banks to the niche areas and to sustain efficiency in the banking system, and a grade approach of bank licensing was introduced, and creating of differentiating banks in India was announced in the Union Budget 2014. Next, coming to the topic of supervisory reforms. Here, Board for Financial Supervision acts as the apex supervisory authority for commercial banks, FIs, and non-banking financial companies. In supervisory reforms, there is the implementation of CAMELS. CAMELS full form is very important, which C, capital advocacy, A, asset quality, B, management, E, earning, L, liquidity. Okay. Supervisory rating system, the transition to risk-based supervision. Next, the recasting of the role of statutory authorities increased internal control. How? Through strengthening of internal audits. Next, strengthening corporate governance. By strengthening corporate governance, there is an enhanced due diligence on important shareholders, fit and proper test for directors. And also, a committee on banking sector reforms in India was set up by government, which was chaired by Narasimhan in order to review the process of banking sector. Next, competitive reforms. In these competitive reforms, PSB's operational autonomy, where that allowed them to obtain capital from the stock market up to 49% of paid up capital. Private and international banks have been permitted to operate in India in order to, why they have permitted to operate in India? To foster a culture of competition and greater choice. Private and international banks has allowed transparent norms for entering of Indian private sector, foreign and joint venture banks, FDI, as well as in the form of FDI as well as FPI to diversify product portfolio and business activities. Next, coming to market reforms. In market reforms include the removal of administered interest rate measures and also reduction of CRR and SLR rates from previously higher levels, discontinuation of ad hoc treasury bills, and also introduction of pure interbank call money market, and also the implementation of auction based repos, reverse repos for short term negotiated dealing system for screen based trading, and also the RTGS system. These all comes under market reforms. Introduction of pure interbank, we have earlier discussed about it, for short term liquidity management, facility of improved payments and settlement mechanism. Next, institutional and legal frameworks. Whereas legal, we know that local adult, DRTs, ARC, settlement advisory committees, corporate debt restructuring mechanisms, and so on, so to facilitate faster recovery. Recovery, these have been developed. Adoption of SARFAESI Act and subsequent amendments to protect creditors' interest. We will discuss about the limits later. Local adult, it is up to 20 lakh. SARFAESI Act, the recovery interest should be below 1 lakh. Next, establishments of the Credit Information Bureau for the information, and also CCIL to act as a central coordinatory party. Next, the banking orbit scheme, which if a person is unsatisfactory with the bank's reply, then he can complain to banking ombudsman scheme. Banks clients to resolve grievances enactment on the insolvency and bankruptcy code. These are the legal and institutional frames. Technology reforms. Okay, in technology, we know that Infinet, which is financial sector's communication backbone, as well as the NDS, negotiated dealing system for screen-based training in government securities, and RTGS. A high-level committee for technological reforms is high-level committee is changed by Dr. K.C. Chakrabarti, representatives from IITs, IBRTs, and Reserve Bank, creating the IT Vision Document 2011-17. Who introduced the IT Vision of Document 2011-17? It is K.C. Chakrabarti of the RBI, which provide roadmap for the increased IT usage in the banking sector, and also new age technologies like artificial intelligence, machine learning. While digital in a revolution characterized PMJDY, EKVC, UPI, these are many more. And also JAM, which is Jan Dhan Aadhaar Mobile. Jan Dhan, J for Jan Dhan, A for Aadhaar, B for Mobile, which is JAM, has been game changer for financial inclusion. And there are also direct benefit transfer, which is initiated by Government of India in 2013 to change the mechanism of transferring cash receipts, subsidies and benefits with the help of technology. Next, debt market reforms. It is a 91-day treasury bill introduced. What's the purpose for introducing debt market reforms? To managing liquidity and benchmarking. There are zero coupon bonds, floating rate bonds, capital indexed bonds were issued, and exchange traded interest rate futures were also introduced. OTC, over the counter interest rates derivatives like IRS, FR, forward rate agreements, interest rate swaps were also introduced. Foreign institutional investments to institute setting up risk free through how CCIL, which is Clearing Corporation of India Limited, and also there is an RTGS, and also repo, which is repurchase agreement for short term liquidity adjustment, and also LAF, which is liquidity adjustment facilities. It has of two, which is repo, reverse repo. The main aim is for short term interest rate, to adjust short term interest rate for both liquidity management. Next, MSS, Market Stabilization Scheme, is issued. What is the main purpose? Available to the RBI for managing surplus liquidity in the system. Next, foreign exchange market reforms. It was replaced by FEMA was replaced by FERA 1973, which is Foreign Exchange Regulation Act, which increases the foreign exchange market instruments, and also authorized dealers permitted. What are the main aim of authorized dealers? They deals with how they can manage and invest in overseas, and among all they will manage. FIIs and NRIs are permitted to trade in exchange traded derivative contracts. They ask which of the following doesn't participate in trade on exchange traded derivatives, and they may give options. We have to remember this FFA, FIA and NRIs. Next, insurance sector reforms, which is IRDA. What is the purpose of IRDA? To govern and oversee the insurance industry. Full form of IRDA is Insurance Regulatory and Development Agency. Next, insurance companies have taken active steps with the innovation distribution channels for the products over and above creating strong agency network. Capital market reforms. Coming to the next topic, here SEBI. The main thing of this page I will highlight it because it has been many more to remember. Regulatory effectiveness, enhancing competitive environment, eliminating information asymmetry, developing modern technological infrastructure, minimizing transaction cost, and limiting speculation in the securities market. So, in 1992, Indian stock market was opened to FIS and also ADRs, GDRs, FCCBs, which is American Depository Receipts, Global Depository Receipts, foreign currency convertible bonds, and ECBs, external commercial borrowings, was granted access to the international capital markets. These are some more which are important reforms that have taken place in the capital market. Just read this point once. Next, economic transformation, the integration with the global economy. Here FDI has risen 0.03% of GDP in 1991 to 2.42 in 2020. And also here is an increase of volume and reversals. Next, economic reforms in India. Here what are the causes that underlie India's economic disaster have been clearly outlined by Jagadish Bhagwati. Here we have to remember his name, Jagadish Bhagwati. He categorized Indian economic failure in three categories. He said that there are three categories why Indian economy has failed: disasters, strong bureaucratic controls over production, investment and trade, and also inward-looking trade on foreign investment policies, and also inefficient public sector enterprises functioning. These are the three reasons why economic failure has come. Next, economic crisis happen in 1990. What is higher fiscal deficit, which overspending leads to increased borrowing and interest cost. Just remember this page. Next, these headings are very important. Higher fiscal deficit, adverse balance of payment situations, political instability, high inflation rates. Pure industrial and agricultural productivity also led to supply side constraints and inflation. Next, this is our last topic in this unit, which is, we can say, macroeconomic stabilization, structural adjustment reforms. In macroeconomic stabilization, we know fiscal policy reforms, tax reforms, balance of payment reforms, monetary policy, inflation control. And in structural adjustment reforms, industrial policy reforms, infrastructure reforms, agricultural reforms, financial sector reforms. So everyone just learn everything, not I can say each point, because they are not giving the questions directly, they give what is the correct, so you have to choose that. So everyone just make your concepts clear and understandable, and you may able to clear it in first attempt. Thank you everyone. Hope everyone understand this chapter.